And so by way of introduction, so first and foremost, for those who joined after my rambling started, a very warm welcome. It's really such a thrill to have you guys. We really do appreciate the opportunity to chat to you. One of the reasons that it's so important for us to be able to chat is not just so that we have the opportunity to explain our side of things, but we also really benefit from understanding what it is that is affecting you in your world. It's one thing for us to sit here in our very comfortable little place with our little stash of crystals and think that everything's fine because what we're doing works and we know that it works, and we can be comfortable with our own process. But you guys have the interface. You're the one dealing with the client. You're taking the direct questions, and there's a plethora of information which needs to be distilled. So when we get the questions from you, when we understand what the actual circumstance is, where this information is actually landing, it really helps us to position the information and the communication that we put out there. So it's as I say, it's just really appreciated. We love engaging with you. Love you guys madly. Must do lunch. All right. So this is the official start of this presentation. And when I was doing the preparation, just in compiling the information, I was inspired by this phrase, risk is the new risk. And just to be very honest, I thought it was brilliant. I thought it was utterly brilliant. And then Ruben said to me, yeah, that's great, but what does it mean? And then I had to rethink. But fortunately, the universe conspires to support brilliance. And the very next day, I saw, or it was actually the Monday, Ruben, you can go to the next one. There were two articles that appeared. The one is John Author's and the other was in the City Wire that really sort of supported my perspective around what I meant around risk is the new risk. So my feeling, sort of standing where I stand, not directly in the asset management, not in the portfolio management space, is that risk has become softened. Risk has become all Walt Disneyed. There's no consequence. There's no direct moral hazard. High risk just means high return. That's all, not losing anything. So it's like Walt Disney has got involved in risk and then real life doesn't apply. But the reality is Bambi dies, shit happens. You've got to realize that we can't go on endlessly in this happy space where my mom will talk to your mom and then everything will be sorted out. There's got to be a point at which high risk has high consequences and the returns come home and they bite. So there was an article that appeared in City Wire on Monday, which just absolutely thrilled me. I loved the way that this journalist described it. He says that investors are being lured back onto the dance floor by the siren song of FOMO. And I thought that was a beautiful description of what's happened. It's like everything's fine. We don't have to worry because somebody's mom will talk to my mom and everything will be resolved. So I think that's the meaning behind risk is the new risk. It's just the good old-fashioned risk, the way it used to be. Like you put your hand in the fire, it gets burned. That's what happens. So I'm going to hand over to Ruben to take on the presentation now. The team is on standby. We've got Ruben, who, as many of you know, is our CIO. He also co-manages these funds with Aubrey. Aubrey is the lead portfolio manager on the multi-asset funds. And we've also got Kasparis Trinecht. Kasi is our guru on all things index-oriented and camping. And I just want you to know that camping is not the new squatting, but Kasi is our camping connoisseur, and he will take questions after this presentation. One of the aspects that we have included in this as well is we step back, we look at our indicators. I think most of you are comfortable to some degree with indicators, but we just give them a little bit of a shake up just to release all their essence so that you can really embrace it and breathe it in and understand it. We look at what the environment is around supporting those indicators. And then we've introduced a new section, which I'm quite excited about. It's called fundamental versus sentimental. And really what we do is we look at some of the, perhaps what could be considered sentimental distractions, where there's texture to them, where there's context to them, and how they might support or not the actual indicators that we use. So that's my story. Ruben, I'm going to hand over to you. Thank you again for joining us.
Thanks, Megan, and thanks everyone for joining us. Just starting off with our current positioning in the funds, we are 100% in local cash. We exited our Swiss francs and dollar holdings. And really, this is a function of the fact that local cash is offering you around 8.5%. We think that's a great risk-adjusted return. And really, all we're trying to achieve here is risk-free return. I think what's available out there in the markets at the moment is return-free risk, and that's not meant facetiously. I think the past 7 days have proven that to us. So right, as Megan indicated, let's have a look at our indicators. As you know, those indicators embody inflation, company earnings, interest rates, and our business cycle, generally represented by commodity prices. And we spend a lot of time looking at those indicators and the underlying secondary indicators. Our bull indicator effectively kicks in, some people call it our buy signal, when the yield curve normalizes and indicates positive economic growth and company earnings are to follow. And then our bear indicator is what happens when real all-share earnings growth turns negative. So as we've said before, this is not based on forecasts that we make, and these are two different indicators. They are not reversible. So when the bull indicator goes the other way, it's not kind of an indicator to sell. These are two separate indicators, and I'll take you through them both in the next 2 slides. So this is our primary bull market indicator, and if you can just watch my cursor, when the indicator moves from below the line to above the line, it's time for us to get back into equities. And we plotted here in red the all-share index. And if you have some time, you can go through and see that every time this indicator kicks in, every time it triggers, it is indeed an opportunity to get back into equities. And from a perspective of our positioning, we're then of the view that the best risk-adjusted asset is in fact South African equities. Just this is simply long rates, less short rates. So in other words, what some people will call the yield curve. And I must also just spend a moment reminding everyone that equities are our asset class of choice. The funds started on the 1st of April 2014, which means we've been managing them for 107 months up until the end of February. It was certainly our intention when we spec these products that we would be in equities 80% of the time. The converse has in fact happened. Of those 107 months, we've only been in equities for 19 months. That's a function of an exogenous factor, which we refer to as quantitative easing. I'll spend some time on that, but just to emphasize that it is our belief that the best asset class in terms of generating inflation beating returns for our investors is local equities. This is our bear market indicator, and once again the red line is the JSE All Share. When this indicator breaks below the zero line, i.e. from top to bottom, it is the time to sell South African equities. What we effectively have here in this indicator is all share earnings adjusted for inflation. So we sold equities on the 29th of August 2018. We've been out of equities since then. As I said to you, this indicator is not reversible, so this wasn't not an indication to get back into equities, but the indicator remains in sell territory and hence our positioning out of equities. So just our philosophy, when we believe that markets are running and that risk assets are the place to be, particularly equities, we are 100% in equities. The underlying exposure is indexed. The distinction between the two products, the prudential and the flexible, is that in terms of Reg 28, we are only allowed 75% to be in the prudential, whereas we can be 100% in equities in the flexible. Depending on what other asset classes are available, we may be 25% in property in the prudential to make up that 100%. And you will find a slight difference between the two products in that period when we are long of equities and risk on. However, when we are out of equities, the two products will effectively be the same. We will effectively be invested in cash, property, bonds, gold, and exposure to offshore will generally be maximized unless we are of the view that that's not optimal for our investors. So let's just look at some insights in terms of our indicators. As I mentioned earlier, the primary indicators reflect those secondary factors of inflation, company earnings, interest rates, and commodity prices, i.e. the business cycle. But over the past 10 plus years, there has been an exogenous factor in financial markets called quantitative easing. And let's just for a moment spend some time and looking at the impact that that has had on asset prices. So what does QE look like? On the left vertical axis here is the amount in trillions of dollars that central banks have pumped into the markets since the great financial crisis, let's say the middle of 2009. So those major economies of the US, China, Japan, and the Eurozone have pumped in total assets represented by this dark blue line and close to 33 trillion over the course of the past decade or so. Where has all this money gone? Because certainly there was a lot of anxiety that banks weren't lending, banks weren't facilitating borrowing in the economies. And this chart is drawn by Merrill Lynch, Bank of America, and they believe that there's a correlation since 2009 of 0.97 between the amount of money pumped into economies by global central bankers and the light blue line, the turquoise line, represented by the MSCI All Country World Index, which is on the right-hand vertical axis. So effectively what has happened is that quantitative easing has resulted in asset prices becoming elevated. We're of the view that in many instances, asset prices have detached from underlying economic reality, hence Megan's reference to Bambi. But this is where we've ended up in terms of asset prices and quantitative easing. So where are we right now? The largest central bank in that equation is the US, and all we want to show you here is the contribution of the United States Federal Reserve to that picture. And we've extended that picture for the recent past, in terms of which the Federal Reserve in the States is slowly starting to withdraw money from its economy. In fact, over the last 12 months, you'll see quite a dramatic reduction in the amount of money that's pumped into the economy. In fact, they are taking money out of the economy. So we've moved in an environment from quantitative easing to quantitative tightening. And while quantitative easing was a tailwind to asset prices, we are firmly of the view that quantitative tightening is going to be a headwind to asset prices. This is also represented if one looks at money supply M2 in the US. This is a chart available on iGraph. And one can see the incredible amounts of money pumped into global economies, and in this instance, the US economy, but now also how that has been withdrawn and has in fact become negative over a 12-month period. There's no doubt that this has had a huge impact on global asset prices, and we are of the view that that has informed our indicators in terms of the exposure to equities over this period. So now let's drill down in that environment, in that milieu, in terms of the sub-indicators which our primary indicator represents. Looking firstly at inflation. So let's just for a moment remind ourselves that Jerome Powell made this statement last week. The latest economic data have come in stronger than expected, which suggests that the ultimate level of interest rates is likely to be higher than previously anticipated. If the totality of the data were to indicate that faster tightening is warranted, we would be prepared to increase the pace of rate hikes. The market spent a lot of time discussing the Fed pivoting. Let's have a look now at inflation. And one of the key things that we have communicated to the market is our belief that inflation is not as docile as many people believe. And really, that's represented by the following two lines, prepared by the Federal Reserve Bank of Atlanta, who take the CPI numbers and split them between the flexible CPI, which is represented by the dark line, and a sticky CPI, which is represented by the lighter line. And what we've done is plot the long-term chart of flexible and sticky, and we've given you the data over here so that you can just go and look at how those two make up CPI in total. And you'll see here that initially flexible CPI rose dramatically and has now come off quite significantly. But what is a problem is the degree to which sticky CPI has become stuck at 6.7. So sticky CPI remained low for an incredible period of time. Just the data point that's recorded here on the graph, sticky CPI was 2.1% in 2014. It remained at that level for an extended period of time, but started picking up towards the end of 2021 and is now at 6.7. That really is our concern. Will that sticky CPI come off as quickly as markets are anticipating? And really, if we drill down into what that comprises, it's really all about services. In other words, excluding food and energy. And one can see over time how that has picked up and is not coming off, as opposed to energy, food, and goods, where the contribution to CPI has reduced. So that's not just an interesting economic comment. It has an implication on financial markets. We are of the belief that financial market participants pay for real economic growth. And you'll see that our indicator, our sell indicator, is a function of that real earnings growth. We take earnings growth and adjust it for inflation. So what we've plotted on this chart over here is on the left-hand vertical axis, the US CPI, and on the horizontal axis, the S&P price earnings ratio for every year from 1961. And we've then plotted the relative data point of the S&P PE and CPI for all of those individual years. The red dot is where we are right now. But what we'd also like to point out is that there's a collection of dots in the period when inflation was 2%. So generally in this period when inflation was low, the S&P price earnings ratio tended to be around 15, 20, and in some years extensively above that. In periods where inflation was high, and these are mostly late 70s, early 80s, you'll see that the S&P price earnings ratio was very low. In fact, in the region of 10 and even below 10 at periods of time. And so when we plot a curve to these data points, that's the curve you get. We are right here at the moment at 6%, that's the red dot. And what we've done on this part of the chart is really just show you where the S&P is priced right now relative to its price earnings ratio. Now remember, this is the historic PE ratio, not a forward PE ratio. So the index value at the end of February was 39.70. We're not of the view that inflation is not going to come down. We believe that it will come down. But what we do not believe is that it's going to come down to 2% as quickly as the market is anticipating. So we've said, well, if inflation drops to 4%, what kind of price earnings ratio could we apply to the market? And at 15, this gives us an indication that the market is still overvalued by around 29%. So that's not a projection we're making. We're just looking at the data coldly, and we're just saying currently the market is overpriced for inflation at 4%, and we believe that that is a risk. We're not alone in saying that inflation could take a longer time to come down. If one looks at a guy like Mohammed Al-Arian, who was at PIMCO and now in academia, he's also of that view. If one looks at research by research affiliates, they contend very strongly that once inflation goes above 6%, it takes a very long time for it to come down. We will gladly forward you this research should you be interested, but certainly inflation, we believe, is not dead just yet. All right. The next secondary indicator, company earnings. Let's take a closer look at that. This is company earnings, the percentage annual change in earnings of the S&P, and one can see the decline and then the incredible jump in earnings as the fiscal and monetary easing kicked in and the low interest rates assisted companies in terms of their income statement. However, contrary to bottom-up forecasts, earnings have been fairly flat over the past few quarters and not reflecting much growth. In fact, when we look at the progression of earnings for the first quarter of 2023, it's not reflecting growth at all. Slightly negative, notwithstanding that bottom-up analysts 3-4 months ago were projecting growth in earnings. And why is this and why are we concerned? This is really a function of the fact that sales are growing at a slower rate than the cost of goods sold. That's going to imply margin pressure on companies, and when companies have to endure margin pressure, they are going to either have to cut staff, cut costs, or report lower profits. And we're of the opinion that there's a probability that all three of those apply. So we are seeing that already in the large tech companies. We are seeing their earnings under pressure, and while they grew unbelievably during the COVID period, we are already seeing a decline from those large tech companies. We've listed them over here: Microsoft, Apple, Amazon, Google, Facebook, Nvidia, Netflix, Adobe, and Tesla. So to summarize, this is what's happening to bottom-up EPS estimates. They are slowly being unwound. We still believe that they are too positive, and we believe that that's going to have an impact on how markets are valued. As a side issue, tech companies are slashing jobs. We prepared this chart and collated this chart about a week ago. I think it was yesterday or the day before that Meta announced they would lay off another 10,000 people. That would push them to the top of the chart. But also bear in mind that very often layoffs are a lagging indicator. Companies hang on to their staff as long as they can, and we believe that this portends weakness in company earnings. Our next secondary indicator, interest rates. We had in financial markets the message that there is no alternative. In other words, one had to go into equities to generate any kind of return. That was while interest rates were below 2%, 1%, and close to the zero bound. Bear in mind that this is the US 10-year bond yield. It's the very foundation of the cost of equity. This is the base into the cost of equity. You add then country risk premiums, you add company risk premiums, but this will result in the cost of equity going up. And one can see how this has gone up over the last few months. And we believe that the implication of the past week in financial markets is a function that the US 10-year has gone up at its most rapid trajectory for a very, very long time. And we have seen this impact now in the banking sector. Not only does the US 10-year in absolute terms tell us something, but also the 10-year minus the 3-month, in other words, the yield spread, gives us an indication of what is happening in financial markets and economies. you can see that every time this spread dropped below the zero line, it was followed by an economic recession in the US. This indicator has worked every time for the past 40, 50 years, yet there are people today who are saying that it should be ignored because circumstances are different. We believe that those are very expensive words. The 10-year less the 2-year, very, very similar picture, and also virtually a fail-safe indication that the US economy is headed for a recession. So just to give one an indication of how much volatility we've seen in the interest rate markets over the past week, you can go through this in your own time, but this really was the implied policy rate on March the 7th, the date that Jay Powell made his comment that we alluded to earlier. And this gives one an indication of what markets thought the implied policy rate evolution would be over the next few months. This is what it was on February the 1st. That's what it was before the meeting. And then market participants hiked that expectation after the meeting by the Fed. I'm not going to go through these in detail, but one can see, if you don't mind me referring to it, as almost confusion in financial markets, as SVB and the implications of SVB have hit the market, Credit Suisse yesterday. And really, interest rates are telling us that there is a lot of uncertainty as to exactly where rates are going to settle. Will the Fed hike? Won't the Fed hike? In this particular milieu, in this particular environment, cash really is king. So finally, let's look at our last primary indicator, the business cycle and commodity prices. This is a very informative chart. It's the trailing 12-month speculative grade default rate in the US market. And all we are showing here is that for the past 14 years, we have not had a situation where companies have gone insolvent. So because rates have been so low, even those companies who are poorly managed with poor business models and are not making profit have been allowed to survive. That just doesn't work in capital markets. It's all about creative destruction. And those companies that are weak have to pay the price. As Megan says, the biggest risk is risk. And risk really is being repriced as we speak. We have a number of people who say, well, we can always hide in the South African market because the South African market is cheap. The South African market is not exposed to international markets. We differ quite strongly from that. We believe, based on our internal proprietary calculation, that currently just below 70% of our market cap in the JSE All Share is exposed to international. We'll also show you that when the US sneezes, the world catches a cold. And this really is the quarterly percentage change in the S&P 500 in red and the quarterly percentage change in the JSE in blue. And you will see that there are seldom times where the two differ from each other. When the US market falls, the South African market will fall. Some other pushback we get from investors is that China will rescue the world. And I think a large component of the run-up in financial markets in December and January was based on that belief. We were never of that view, and really all we looked at was the US Institute for Supply Management Index and the China index of similar constitution. And it was quite clear that if the US comes off, China will follow. The US remains the largest economy in the world. China is the second largest, but the prospect of China growing and outperforming and lifting up the US and the rest of the world, we believe, is very, very low. So as Megan says, we're now going to spend a few moments looking at fundamental versus sentimental indicators. And perhaps another way of describing that is looking at potential black swans. So historically, human beings always prepare for the last disaster to strike them. our experience in financial markets, it's never the same disaster that strikes you. It's always something completely different and unanticipated. And so we just want to highlight one or two things which we think investors should take note of. The first one, and probably one which concerns us the most, is student loan debt in the US. And all we are showing you here is the extent to which this has grown relative to overall GDP growth. We don't believe that this is a situation that can continue, and we certainly believe that the US has to take action on this. It is going to be a problem. Leading indicators always peak before a recession. Once again, if one goes back 50 plus years, one can see how these leading indicators generally roll over before the shaded areas indicative of recessions. And once again, this is giving us a signal that the global economy is not headed for a great space. And then just an internally generated proprietary chart, and one that we think investors must take cognizance of. All we are looking here is at the South Africa's terms of trade. In other words, we are looking at the major commodities that we export, import, and we are comparing that to the rand. One will see that for a very long time, there's a very tight visual correlation between those two lines. The rand represented on the right-hand side axis, and please just note that it's inverted. So it goes from 6.6 down to 19 and 18.5 where it's currently trading. But you'll see that there was a breakdown here towards the middle of the COVID period, where our terms of trade continued to go up and the rand commenced weakening. We believe that that's a function of the exogenous factors which have hit South Africa over the past 2 years: load shedding, governance, corruption, and that's been priced into our currency. Bear in mind, we've also been downgraded over that period. So certainly this is something that concerns us quite substantially. This is something that we are acutely aware of, but also something that we believe investors should be cautious about and should be aware of. So in conclusion, we remain positioned in cash for no other reason than we believe it provides our investors with the best risk-adjusted return. Our application of our philosophy is summed up by this comment from one of our team. We are at the auction every day. So people think that we don't do much when we are in cash, but that's not the case. We are reviewing the options, we are reviewing what's on offer, but we are comfortable that our indicators will signal any compelling option besides cash that will deliver the optimal risk-adjusted return for our investors. Is the bond market offering value right now? I think we got to a stage where we thought that was indeed the case, but there have been another number of factors which have reared their head, and certainly when we see value in bonds, as we did in 2021, we will increase our bond exposure. It will be an indexed exposure, and we will invest in the govie when we believe that offers value. Then also just to remind you that we do make cash sweat. So if one looks at the past 9 years that we've managed these products, whenever we've been in cash, we've added between 1 and 2% to that cash return by investing in international currencies. So we believe that there are often mispricing opportunities between the dollar and the rand, the Swiss franc and the rand, and we certainly use those opportunities and add value to our investors. So in conclusion, where does this leave us? I'm just going to run you through this chart. Most of you should know it. The purple line is the return of the Gryphon Prudential Fund since the 1st of April, when we started this product. The dark red line is the JSE All Share Total Return Index. The blue line is the All Bonds. The black line is the average of the South African multi-asset high equity peers. And then the green line is cash. So looking at the degree to which We have outperformed not only the individual asset classes, but also our peers. I think we've shown you and we've told you and explained to you that the objective always was to deliver an NAV which was solid, which was stable, and which did not expose our investors to a huge amount of volatility. We think what is significant is that over the 9 years that we've managed this product, we've often heard people in the market saying, I'm going to stay with equities and then just wait for an opportunity to sell. I think if the past week has taught us anything, is that opportunity never comes. And when it changes incredibly quickly. So our belief is that if we want to get out of the market, we get out of the market well in advance, because when the market does turn, it's quick, it's vicious, and it certainly doesn't give one the opportunity to make a decision in any time or with time. One has to be ahead of the market. And so if we look at what generates this return and this solid risk-adjusted return over time, it's reflected in this chart. And the rule number one that we are referring to is the statement that Warren Buffett often makes. There are only two rules in investing. Rule number one is don't lose money. And rule number two is never forget rule number one. And you're welcome to go through this in your own time, but you can see that this is a drawdown chart. And it just shows you how seldom these products have drawdowns. And when they do have drawdowns, they are not significant. And when they have drawdowns, they are quickly recovered. We believe that this is a fundamental to us generating returns, which not only outperform asset classes, but will also outperform the market over time. Thank you very much. Megan, over to you. If there are any questions, please.
Thanks so much, Ruben. I do have a question that I'd like to put to you just in regard to the terms of trade graph. The question is, in terms of this graph, does it imply that our terms of trade are going to worsen? And if so, what does that mean?
Sorry, does it imply that?
That our terms of trade are going to worsen? And if so, what does that mean?
Bobby, you want to give that a chance?
Can you guys hear me?
Yes.
Good morning. The short answer is we don't know, but it can.
I could have given that answer.
Yeah. Maybe if you just put the chart back on. Ruben, if you can put that chart of the trade.
The terms of trade. Ruben, put the
chart
back.
Okay. All right, so here we go.
Yeah. The terms of trade was held up in 22 hugely by our exports of iron ore and the big one, coal, which is coming down quite significantly, and one can see that pullback in the coal price there since the start of 2023. My view is that some of those prices can come down significantly more because of global demand getting under pressure, which will pressurize those prices further. So the rand is already discounting a lot at where it is point in time. And one can go and reason it should be probably 13 or 14 to the dollar, but like Ruben indicated here, is that a lot of our local political and load shedding and whatever else situations are causing the rand to be at very weak levels. So the rand is already discounting a lot of that. But yes, my feel is that if global demand is going to contract more, our terms of trade can go a lot worse, and then there's a lot of other implications. Our tax collection is going to be under pressure. So we'll have to borrow more. So keeping the rand under pressure. But as I'm saying, the rand is discounting already a lot of that bad news. Megan, you muted. Megan, you are muted.
Yes. If only I would do that more. I know. I do when I should, and I don't when I shouldn't. But I've got one more question, another question, either Ruben or Aubrey. Can you talk a bit more about the confusion in the market about the path of interest rates, given what we've seen in the banking sector? Does this raise the risk that central banks take their eye off the inflation problem?
Yeah, I'll try and respond to that. It's very difficult to say. I certainly think that in terms of those evolving curves and interest rate curves that we've shown you, certainly that is what the market thinks. I think we must just bear in mind that when you do have a banking, and let's not call it a crisis, but let's just call it an event. When you have a banking event like this, everyone does become more cautious. So the small banks like SVB start reconfiguring their balance sheets. The larger banks start lending less to prospective borrowers. And so in effect, an event like this does do some of the work that the Fed wants to do in slowing the economy. The question is it an event which is going to slow the economy more than the Fed anticipates or less than the Fed anticipates? And if you go back 12 months ago, you will recall, or you may recall us saying that one of the biggest problems we have with being in risk assets is that the Fed has put itself in a position where it's going to make a policy error. And we believe that what's happening right now is a reflection of those policy errors. The Fed has put itself in a position where it actually doesn't know what it should do. And that makes all risk assets that much more risky. Aubrey, I don't know if you want to add anything.
Yes, I think the problem with QE is that it's easy to do it when inflation is not a problem. But now inflation is still a problem, so it's not that easy to do QE at these levels of inflation. And just to explain it, it's basically the national treasuries of the countries that's doing the QE. They selling those bonds at a low interest rate, and that was, say, after the 2008 crisis. Now, if they've got to roll those bonds and issue new bonds, they're doing it at significantly higher levels of interest rates, and that's why it's important for inflation to come down if you want to really do some more QE. So I think the central banks' hands are a bit tied in at this point in time, and they don't have the luxury of doing some more QE just because interest rates and inflation is a lot higher now.
Okay, thanks. Any more questions? No pigeons arriving with messages. All sources of questions appear to be fulfilled. If there are no more questions, it simply remains for me to, again, thank you. Thank you so much for your time. Thank you for the opportunity to engage with you. Again, an invitation to give us a shout if you would love us to come and chat to you, either online or in person. But we would really gladly engage, gladly go through this, go down the little paths that present themselves in this regard. I will send out a copy of the presentation, and I will also send through, hopefully, a recorded link if the tech gods are in my favor. And then we'll just be in touch as things develop. But if there are any other questions, please mail me, get in touch with our team. But otherwise, we just have to say, love you madly, must do lunch.
Thanks,
Thank
everyone.
you, guys.